In this video, I'll be breaking down the different ways banks make money off their customers like you and me, and I'll also be sharing some tips on how you can keep more of your hard-earned money and make it work for you instead of your bank. Let's dive in. First and foremost, banks make money on your money. When you deposit money into a bank account, the bank becomes the custodian of the money and promises to safeguard it while providing you access when you need it. But here's the thing. Although banks are pretty much just piggy banks for grown-ups, your money doesn't just sit there in your bank account. Banks actually use your deposits to make more money for themselves. How do they do that? One of the main ways banks make money is by lending out your deposits to other customers at interest rates that are astronomically higher than what they pay you on your deposits. This is called net interest income, and it refers to the difference between the interest income banks receive on loans and the interest they pay out on deposits. The wider the difference, the more money they make. And what does this mean for banks? Well,
Money, 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 money.
the interest traditional brick and mortar banks pay customers, if any, is frankly embarrassing. Thankfully though, if you have money tucked away in one of their savings accounts, they may generously offer you 0.01%. That was sarcasm. It's a joke that they even call these things a savings account. In addition to lending, banks also make money by investing your deposits into various financial instruments. And you know what? They make a ton of money doing it. So it's a good thing they pass some of that along to their customers, right? In case you missed it, that was also sarcasm. These banks are the ultimate frenemy, pretending to help you save money while secretly making a fortune off of your hard-earned cash. Unfortunately, we're not taught this in schools, and we're certainly not taught where to put our money to make it work for us instead of our bank. And so I made a video breaking it down, and I'll link it somewhere over here. Let's dive a little deeper into interest income. Banks earn interest on lending services such as mortgages, personal loans, and credit cards. Credit cards are among the highest interest products a bank offers. Some credit cards can charge up to 30% per year in interest. So those little plastic rectangles that magically grant you access to money you don't actually have are a massive profit center for banks. When you swipe your credit card and buy something, you're essentially taking out a loan from the bank. And like any loan, you'll have to pay it back with interest. With credit cards, if you carry a balance, meaning you don't pay it off in full every month, you'll be racking up interest charges like crazy. And banks know this all too well, which is why they make it so easy for us to overspend on them. First off, let's talk about credit limits. Banks will usually offer you a higher credit limit than you actually need because they know it's going to make you feel baller and more likely to spend. The more you spend, the higher your balance they can charge interest on, which means
Money, 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 money.
then there's rewards. Banks love to lure us in with all kinds of perks and rewards.
Sign up for our credit card and get 50,000 points. Use your card and earn cash back on every purchase.
Sounds pretty sweet, right? But here's the catch. Those rewards are designed to make you spend more. And if you're not careful, the interest you'll pay on carrying a balance will easily wipe out the benefit you receive from your rewards. Banks will also typically offer you a low introductory interest rate, but after a few months, that rate can skyrocket. And if you're not paying off your balance in full every month, you'll end up paying interest on top of interest. It's like a never-ending cycle of debt. But that's not all. Banks also make money on late payment fees, over-limit fees, balance transfer fees, you name it, and they've got a fee for it. And these fees can add up fast. All this is not to discourage you from using credit cards. In fact, I almost exclusively transact on credit. Credit cards are a tool that can either help you or hurt you depending on how you use them. It's up to us to be smart about our spending and not fall into the traps set up by our banks. The best way to avoid fees and interest charges is to only spend what you know you can afford to pay back and make sure you pay off your entire balance on time every month. Next, let's talk about overdraft fees. Banks are notorious for charging all sorts of fees that aren't exactly advertised in bold, bright colors. They're often hidden in the fine print and buried in pages of terms and conditions that no one ever reads. The first of these fees is the good old overdraft fee, which we've all been stung by at some point. It's a classic example of banks trying to squeeze every last penny out of their customers, especially their most vulnerable ones. Overdraft services are sneakily marketed as overdraft protection and overdraft relief, making it sound like something you should absolutely opt in for. And while overdraft services may provide a short-term solution to cover urgent payments, or avoid bounce checks. It's egregious to slap a $35 fee on an account that's already overdrawn, especially if it's just by a few dollars. Normal people just trying to make it are severely damaged by these fees. And it's a punishment that simply does not fit the mistake. And here's the kicker that many people don't know. Until recently, some banks were unethically reordering transactions in order to maximize the number of overdraft fees they can charge customers. This is how they did it. Let's say Maria has $100 in her checking account. She takes an Uber to work, costing her $15, leaving her with a balance of $85. Later, she spends $10 on lunch, and then after work, she ducks past the mall to buy a pair of new shoes for $40 and groceries for the week, costing her $65. Unfortunately, the groceries cause her account to become overdrawn by $30. Rather than charging her one overdraft fee, her bank rearranges the transactions from highest to lowest and charges her 3 overdraft fees of $35 each. By processing transactions from highest to lowest, banks are able to quickly collect overdraft fees and maximize profits. Thankfully, there's some good news. More and more banks are feeling the heat from federal regulators and consumer advocates and are finally taking action to reduce or even eliminate overdraft fees. Many banks have now changed their policies to give you grace periods, they've introduced safety zones, revised how they order transactions, and have either reduced, capped, or eliminated overdraft fees altogether. So if you've been frustrated by overdraft fees in the past, things are looking up. A little side note, I came across some really hilarious crap when I was doing my research on how banks are marketing these fee reductions. Check this out on Bank of America's website. It says,
The company leads the industry in helping clients avoid overdrafts, and in doing so, has significantly reduced the vast majority of fees related to overdraft.
a little further down it says,
We remain committed to taking actions that will further bring down overdraft fees in the future and continue to empower our clients to drive positive changes to behavior pertaining to overdraft.
I'm sorry, what? It is absolutely absurd to be marketing yourself as a leader of change when the change you're making has been driven by competition and pressure from regulators and consumer advocates. It would be like a person repeatedly breaking the law by driving under the influence of alcohol, causing harm to themselves and others, and then boasting about how they changed the behavior after getting their driver's license revoked. While it's good that they eventually stopped engaging in dangerous behavior, it's not something to be proud of or market as a positive accomplishment. In the same vein, consciously implementing unethical policies and then being forced to change them doesn't make you a leader of change, but rather highlights the lack of ethical leadership and decision-making in the first place. Anyways, it's important to do some research and find a bank that offers an overdraft policy that works for you. You can also make use of helpful tools like low balance alerts to prevent overdrafting your account. The easiest way to completely avoid overdraft fees is to have and stick to a budget and opt out of overdraft protection. This will generally mean your card will be declined if you don't have enough funds in your account. As overdraft fees decline, will banks compensate by raising fees elsewhere? We don't know for sure, but it's something to keep an eye on. Make sure you check your accounts regularly and watch out for any unexpected fees. Here are some common fees you should be aware of. First is monthly service fees. Monthly service fees are sneaky little charges that banks tack onto your account each month for the privilege of keeping your hard-earned cash with them. 2 common monthly service fees are account maintenance fees and minimum balance fees. Most banks that charge monthly service fees offer ways to avoid them. But remember, this isn't done out of generosity. It's strategically designed to deepen your relationship with them. Depending on your bank, you might have the option to avoid these fees by either having your paycheck directly deposited into your account, maintaining a certain minimum balance, or meeting certain deposit and transaction requirements. If you have multiple checking accounts, you could consider whether consolidating your accounts into one could help you avoid these unnecessary fees. But what can you do if your bank's requirements are too difficult to meet? Consider switching to a bank that offers free checking accounts. These days, there are many out there. Next up, we have ATM fees. ATM fees are charged for using an ATM that is out of network. This means they are not owned or do not have a partnership with your bank or credit union. Keep in mind, when you use an out-of-network ATM, your own bank may charge you for using that ATM, and the bank that owns the ATM may impose its own non-customer ATM surcharge. That's a nice little double whammy for ya. Don't just accept this as a necessary evil. You can avoid ATM fees by choosing a bank that has plenty of in-network ATMs near you and then only using those ATMs, choosing a bank that either reimburses all out-of-network ATM fees or at least a set number of them each month, or getting cash back when making purchases with your debit card at stores that offer this option. And finally, the pesky little hidden fees. The bank fees we've talked about already are the common ones and are usually a little easier to spot. However, you should keep your eyes peeled for hidden fees like transaction search fees, paper statement fees, early account closure fees, money transfer fees, international transfer fees, the list goes on. If you prefer banking with the traditional brick and mortar bank, carefully read the bank's terms and conditions. To avoid these fees entirely, take a look at the range of challenger banks and fee-free alternatives that pride themselves on transparent pricing. Before we wrap up, I want to share something I found super interesting. The average age of a marriage that ends in divorce in the US is around 8 years. Yet somehow the average customer sticks with the same checking account for 17 years. According to a recent survey by Bankrate, people cite too much of a hassle to switch, and it's an account I've always had among the reasons they stick with their current bank. But honestly, if you're paying too much in fees, it might be time to shop around because there are plenty more fish in the sea. Banks are supposed to be there to help you manage your money, not bleed you dry. By being aware of the different ways banks make money, you can take steps to avoid nasty fees and make your money work for you instead. These days, there are many financial service providers that are doing away with the nickel and dime culture of traditional banks. By finding an account that suits you best, you could save hundreds of dollars each year. That's money that could be used for saving and investing. No one likes extra admin, but it could be a worthwhile investment of your time. And that brings us to the end of this video. As always, I hope this video has been helpful to you. If it has, please don't forget to like and subscribe. Thank you and see you in the next video. Bye for now.